Again, welcome everybody. This evening, trading strategies for impending volatile markets. My name is Don Kaufman. I'll be your host and trader this evening. Let's move forward. Risk disclosure, we're not financial advisors, nor are we a broker dealer. No soliciting, no recording, no photography. Do not feed the monkeys either. By the way, I throw the risk disclosure up here. I was in the brokerage business for 15 years. I'm no longer in the brokerage business. All right, copyright disclaimer. This is ours. This is not yours. If you want a replay of this, we'll provide a replay of this. The other primary reason I like to throw this up here is this has got all of our contact information on it. So if you want to get a hold of us, we are based in Scottsdale, Arizona. That's where I'm broadcasting from this evening. And the email address. We use a common inbox, support@TheoTrade.com. If you ever got to get a hold of us, go to support@TheoTrade.com. Yes, we answer emails. Yes, I answer emails. Okay, we answer hundreds and hundreds of emails every single week. We're more than happy to be able to answer those emails. Next, a little bit about me. Again, my name is Don Kaufman. I have been around this industry since the late 90s. I started trading in Chicago in the late 90s, about 3 weeks outside of college. About 2 years after that, I was introduced to a few individuals that worked on the Chicago Board Options Exchange that were starting a brokerage firm. That brokerage firm happened to be called thinkorswim. I was at thinkorswim from basically the very, very beginning. There was a handful of employees in a very, very small office in the kind of north side of Chicago. Anyway, yada, yada, yada. We took the company public in 2007. We were eventually acquired by TD Ameritrade. I ran the education for TD Ameritrade from 2010 to 2015, and there's 7 million clients before we left. And I say we, several of us here at TheoTrade were running portions of the education. Ultimately at TD Ameritrade, we left, we launched TheoTrade. So again, I have a 20-year trading career as a derivatives risk manager. And I trade stocks, options, futures, and yes, I have a tremendous amount of thinkorswim platform experience. I've done a couple of CNBC tours over the time. Again, this is being the most memorable because it's up against, Mr. Wonderful himself. A little bit about TheoTrade. We specialize in education for stocks, options, and futures. By the way, I always mention this. I'm an equal opportunity trader. I often get labeled like you're an option guy. Well, no, actually, in the beginning of my career, I traded a lot more futures than I ever did options. But I've traded, tens of millions of shares of stock, millions of shares or millions of, I should say, contracts of futures, and literally millions of option contracts, both as a risk manager, as a private trader, and as a risk manager for what at the time was thinkorswim and then TD Ameritrade. So TheoTrade is founded by professional traders. All of us on the instruction crew, all of us on the instruction crew here at TheoTrade have a minimum of 15 years of experience. A couple have a few decades deep in here. TheoTrade, we are here to help you mitigate the risks, okay, to navigate markets and learn a skill set that can last a lifetime. Another aspect that I think is just incredibly important, TheoTrade is not just myself. It's not just Don Kaufman. Here at TheoTrade, we now have 7 full-time instructors. So obviously I am one of them. Jeff Bierman. Jeff actually worked with me at TD Ameritrade. He was the former chief market technician for TD Ameritrade. If you've ever been on thinkorswim or the charts, it's actually Jeff that helped create most of the studies there. So he's kind of the our prized possession in charting technology. Next, we have Matt Williamson. He's our market neutral premium selling option strategist. Corey Rosenblum, senior strategist. Corey is kind of our resident swing and trend trader. Then we have Brandon Chapman. Brandon also worked with us at TD Ameritrade. Brandon is awesome. Macroeconomics, technicals, and fundamentals. Okay, challenging. There's nobody in this industry that knows macro better than this guy. Steve Slim Miller, 43-year veteran. Actually, Steve started on the options floor the same year that the options floor started. So 1973 is when he actually kicked off trading options. Last but definitely not least, Tony Rago, our Nasdaq futures and intraday strategist. Tonight in this presentation, Four major concepts that I'm going to drill home to you. You're going to learn why rising interest rates will continue to spur an increase in market volatility. All right. Number two, how to determine what strategies and trade logic that you're going to need to thrive in a more volatile market environment. Number three, discover why options premium selling strategies. It's going to be the go-to strategy. Premium selling hasn't been in vogue in many, many years. It's coming back right now, and it's coming back in a big way. And how to find the highest probability trades while learning to cut down your overall market risk. I got to stress that. All right, now we're getting into it. Guys, ready? Monkeys throwing darts. I figured I'd start with this isn't necessarily fun. This is reality of the markets. The last 10 years, monkeys throwing darts made money. By the way, those monkeys throwing darts, some people call them fund managers. And the irony is you could have thrown money into the marketplace, and for the most part, if any of that money landed in terms of tech, you made money. But moving forward, you're going to need a definitive skill set, right? And yes, I believe that is a monkey, and that's not an iPad. I'm going to have to go with that. That's a Surface, right? The monkey, the Surface, it's a Microsoft product. What we intend to do tonight is introduce you to the skills and, more importantly, the criteria needed to thrive in, again, what is going to be a marketplace where you're not necessarily going to be able to be a monkey throwing darts. Now, to kind of kick this off, as I mentioned, rising interest rates, the party is ending with the Fed. All good Fed things must come to an end. Starting in 2018, the Federal Reserve is effectively departing the marketplace and will commence contracting what has become a $4.5 trillion balance sheet. Now, I've mentioned this in other presentations, but some of you are brand new, but this is of critical importance. Okay? Listen very carefully. The Fed is telling you precisely what they are doing. Are you listening? Right? Are you listening? They're telling you that they're going to contract a $4.5 trillion balance sheet. As the Fed capital declines, interest rates will increase. Oh, okay, that's going on. Investors and traders will be forced to unwind positions in countless marketplaces. I'm going to show you that in a moment. In effect, as the Fed pulls away the punch bowl, capital markets will become increasingly volatile. This is the Fed. When I say this is the Fed, all right, so this was right there. That line is the beginning of 2018. Right now, here we are. Okay, and we can actually draw a little bit of a line on that if you're not comfortable, okay, with that right there. That's where we currently are, except we're a little bit deeper than that. So the Fed has actually been chopping away at the balance sheet pretty aggressively, especially last month. They actually did not roll over a bunch more debt. So right now they're contracting what was a $4.5 trillion balance sheet. Now there's a lot going on in this slide. All you need to know, okay, this is the punch bowl and it is rapidly being drained. Bottom line. Now I got another slide that is going to really bring some clarity to this marketplace that I just haven't seen this slide, too many places, and I cannot stress, okay? This is actually recently put together by none other than Bloomberg. And I love it. I like to give credit where credit is due because, they put this together and it is absolutely astounding. It is a comparison chart. And I just want to stress what it is. Okay. The comparison chart is debt, okay, to S&P. That is how much debt the U.S. is, accruing versus the S&P. Just wanted to throw that one out there because it's quite entertaining given the fact that right now we're contracting, again, some of the balance sheet, but total U.S. debt compared to the S&P. And really, it is from the financial crisis to basically right now. All of that, all right, happens to be, I say all of it, all of the debt happens to be in an incredibly next to zero interest rate environment. Now, for the interesting parts, the writing is on the wall, literally. There are a lot of positions that I've taken this year, and people, they've been emailing me nonstop. They're like, how did you know that, this particular underlying would fall as hard as it has. And it happens to be with like either one of the home builders or, a couple of the other stocks that have actually been in short positions. And the answer is, when it comes to home builders, I just did one thing. I listened to the Fed. That's it. What the Fed told me exactly what they're going to do. Why would you think anything other than that? The Fed will continue to raise rates and they're going to contract the balance sheet. Pretty easy, right? Central banks around the world have already started to follow suit, except somebody like, Japan. They're not really doing it, but they are. The European Central Bank is contracting balance sheet, or, well, actually, I should say they're tapering right now, getting ready to contract that balance sheet. But moving forward, you need to be fully aware. The Fed, they no longer got your back. Okay? It's time to get back to selling options premium. As increases in volatility, they are forthcoming. Now, let's get to why. Let's get to the specifics. Before we get into strategy, it is critically important that you understand what the Fed is trying to do. Higher interest rates, well, that's what they're trying to do. Produce volatility. Bottom line, okay? Higher interest rates, okay, produce volatility. In a higher interest rate environment, all of the following are going to be relevant. Now, I'm going to point these out, and then I'm going to take you through and give you some detailed analysis of this. Okay? First of all, the cost to finance positions for major trading firms. Now, that's something a lot of people are not familiar with. The cost to finance position for major trading firms increases substantially. Okay? It's called the cost of carry for net positions makes firms, they have to contract capital from the markets. What it basically means is this. Firms go out, big market making firms, they borrow tons and tons of money on margin. Tons of money, billions and billions of dollars. Well, as soon as the short-term rates start to get up there over like 2%, doesn't make sense for them to do that, so they start contracting capital. All right? That's one of the first points. Number 2, stock buybacks. Stock buybacks, absolutely record-breaking this year. We're going to hit over $1 trillion in stock buybacks this year. However, those are going to become, moving forward, they're going to become less viable as firms can no longer borrow capital at rock-bottom rates in order to repurchase their own stock. So, bear with me for a second. If you're not familiar with these first two, okay, you're probably going to be familiar with this third one, fixed income. Fixed income, once again, becomes appetizing, as being paid 4% on capital looks excellent compared to the last decade. Do you realize that just in the last couple of weeks, okay, there's a bunch of companies that started offering CDs again, right? Banks, CDs. In fact, one of the CDs that was offered was HSBC. I don't know if you guys know who that is. HSBC. It's a bank. They had a 4% CD that was offered, right? I got emailed about the offering. Many of you probably did as well. But yeah, so that starts to look appetizing. So what do you think people do? They go, I'm getting near retirement. I'm going to be pulling some capital from the marketplace. Consumer debt. Okay, let's move on. Consumer debt becomes a burden. As rates increase, so do defaults. Consumer debt, interesting. How could we find that? Well, housing valuations slow or decrease. The ability to borrow against equity within the home stalls. Okay, car sales, they're going to falter. 0% loans, they're completely drying up right now, and discounts are getting hard to find as automakers try to preserve profits. Now, all of this comes to fruition, not because I say so. Go look at the charts. First chart we're up. Fixed income becomes appetizing. What is fixed income? Fixed income happens to be what? Bonds, notes, rates, right? This chart that you're looking at is the TNX. And the TNX right now is at 3.2%. That's the 10-year. It's already at 3.2%. It took off to the upside, which means, okay, that you can get some decent money on your money. The funny thing is, though, you could even put your money into a 2-year, and a 2-year right now is paying 2.88%. And very few people are even aware of that because they never looked at the stuff over the last 10 years. So as soon as fixed income becomes appetizing, everybody's starts to withdraw capital from the marketplace. Fixed income again becomes alluring. Next, this is an interesting one that most people are not looking at right now. This happens to be MasterCard. Consumer debt becomes a burden. As rates increase, so do defaults. All I'm trying to show you, this is a 9-month chart. You guys, please, you can pull up 5-year chart on MasterCard. Go look at 5-year chart on MasterCard. This is the most serious volatility. This is the last 4 trading sessions. That's the most serious volatility we've seen on MasterCard anytime in the last 5 years. Okay, Anytime. It's more volatility than we've seen during their earnings period. By the way, it's not just MasterCard. It also happens to be Visa. This is Visa. Consumer debt becomes a burden, right? What happens? Rates increase, so do defaults. Again, huge volatility inside of Visa. It's the largest drawdown in Visa, again, in a 5-year period of time. Take a look at that stuff. Next, XHB. Housing valuation, slower decrease. The ability to borrow against equity within the home stalls. Okay, so what you're looking at right now, this is pretty much since the beginning of the year to right now. This is a product that's getting absolutely eaten alive, decimated. Right now, you actually have one of the longest streaks going for number of down sessions in a percentage marketplace on a major ETF. Check that stuff out too, right? So that's your home builders. So all of this is coming to fruition, but there's a little bit more. This is actually Home Depot. This is one, if you guys tune into the videos that I do in the evening videos, talk a lot about Home Depot. And I've talked a lot about like Lowe's. But Home Depot, housing valuations are going to slower decrease. But people kind of forgot about the ability to borrow against equity, okay? It's going to cause what? Well, home repairs and so forth. Well, now we're actually seeing volatility starting to hit Home Depot. All right, moving along. Car sales falter. 0% loans are drying up. Have you guys looked at the auto? All right, look at the auto industry. It's absolutely getting decimated. So GM, stellar gap to the upside. It's fallen. Again, these are all 9-month charts. I have to be consistent in doing this stuff. It's a 9-month chart. Can't make that stuff up. Multiple year lows. If you don't believe in GM, okay, maybe you'll believe in Ford. Ford has actually now fallen to under a $9 stock. Okay, the interesting irony about Ford and GM, Ford sales are actually crushing some of the Japanese automakers right now. Their sales are not that bad. They're better than were expected, and the underlying has gone down. Everybody sees the exact same thing. Listen to the Fed. They're telling you what they're going to do. Okay? Writing is on the wall, and I cannot stress this enough. By the way, there's infinite variables I could go into. I just wanted to throw some companies up there that were just grapefruits. Okay, as soon as the Fed said we're going to contract the balance sheet in late December, all you had to do was listen. Now they're actually telling you that they're going to press it, that we're not even what they call neutral status. That's why more recently some volatility is starting to hit. And I got to stress this stuff. Do not flush your money. You got to be a little smarter than your competition. You need to learn skills that can profit from volatile markets, right? Now today, we're going to discover a non-directional trade logic you can use in order to profit from stock, from index, or ETF volatility without taking on drastic risks. That's an important concept. And the other main concept on here, what I'm going to be talking about this evening, is very much non-directional. I'm telling you, it has been a very, very long period of time since we've gone into any degree or depth, okay, me personally, about non-directional. These are the strategies I grew up on from, 98 all the way until about 2004, selling premium, okay? Non-directional was the way to go. Obviously, in 2007, 2008, all the way through to 2013, the premium sale was absolutely stellar. When the Fed stepped in and squashed risk and squashed all the edge out of the markets by throwing so much money into quantitative easing, okay, everything changed. Things became efficient. But now we're starting to see cracks again, and that inefficiency, okay, is coming out, and we're shifting, and we're in this period right now where premium selling, you got to get the skill set under you right now. You can't hesitate on this. Learning to sell options. So many of you kind of heard through the grapevine, like selling options, the way to make money. There are places that just say, you should always sell options. You should always sell options. I disagree with that. I really, really do. Like, I totally disagree when people go, you should always sell options. Yeah, you should always follow lemmings off the edge of the bridge as well, right? No, of course not. You shouldn't always sell options, okay? Because if you've experimented with selling options, okay, you know that there's risk involved. And I'm laughing about it because I watched this progression from a brokerage firm, for the better part of 15 years. Okay? Today's session, we're just going to separate the myths from the real risks, the fact from the fiction in selling options premium. Okay? And now we're going to start to dig into this. Now, don't panic. You can do this. Okay? A few of you tonight may know nothing about options. That's okay for today's session. All I want you to do, grasp big concepts. Grasp the logic, right? What the logic basically is, what am I even doing? Don't worry about the little nuances. That you can pick up later. Big concepts, though, regarding probability. Big concepts regarding risk. Let's dive in. Probability and profitability. Okay? Trading is based on probability. You and I can create trades all day long with a 90% probability of success, but you can still lose money. That's the one thing, I'm gonna pick on this for just a second, and I think it's worth the pause right now, but people constantly go like, hey, what's your track record? Let's say that my track record is 90%. You know what that means? It doesn't mean squat. Who cares if somebody has a 90% track record? Because what's going to happen to them the other 10% of the time? All right? That's what premium selling is all about. I can create a trade all day long with a 90%, chance of making money. Who cares? Don't be misled. Probability alone does not make you profitable. Probability alone does not make you profitable. Remember that. Okay? Markets, they're a trade-off. Markets are a series of trade-offs. Higher probability equals higher risk. That's without unequivocation. You could be right 90% of the time, and you could still lose money. How many people have ever done that before? It's a fair question, right? Anybody? How many people have ever gone out and you've been right, 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 and then all of a sudden, I was wrong. I was so wrong. I was so wrong that it still hurts to this day. Oh, come on, people admitting it's the first step. Nobody? Because that's what the thing is with high probability. Okay? Oh, come on, like 5 people are willing to admit it. By the way, even if you're watching this on a the recording, you should talk to the screen. You should be like, "Oh, hell yeah, I got killed selling premium." Because that's the thing about selling premium. Selling premium, it's really good at luring you in. It's like, "Come on, a little bit more. Little bit more. Oh, did you make money again that time?" It is vicious that way. I just, I've watched this for so many years. But where can you find an edge? I mean, that's what people are here for. So let's get ready because we're going to show you a couple of important things. Now, this is just a blank slide. Why? Because I'm going to draw all over it. We're actually going to talk a little bit about selling premium right now. I'm going to take you into this, and I'm going to take you quite deep into this, and we're going to go deeper and deeper and deeper, okay? But we're going to start with a couple of the basics, and when I say we're going to go deeper and deeper and deeper, I ain't kidding, okay? I ain't kidding. When most people learn about selling premium, this is a stock. I'm going to call this stock, okay? This could be representative. It could be the spiders. It could be the SPX. The SPX, by the way, it's the mother of all products, big and small, but it doesn't matter. It's a $100 product. Now, what selling premium really breaks down to, okay? You're going to go out and you're going to sell, okay, an out-of-the-money option. Let's say in this case, and I'm going to take you through a couple of different examples, but we're going to sell, for example, a 110 call, okay? We're going to sell a 110 call. And let's say on this 110 call, we collect, let's just call it $1. Now, for those of you that are brand new to this, first of all, how do you sell something you never owned? What is a call? Okay? We have this 110 call option. The 110 call option is trading for $1. Oops. It's trading for $1. That's $1. So a 110 call. What's a 110 call? 110 call gives the right to buy the stock at 110. That's if you're a buyer, it gives you the right. But you're not buying the call. You're doing what? You're selling it. Okay? And when you're selling the 110 call, you don't have the right to buy the stock at 110. Somebody has the right to buy the stock from you at 110. And you go, whoa. I don't own the stock. You don't have to own the stock. You could just sell the call. Now, selling it and selling it naked could be a dangerous thing, because if you sell a 110 call, just tell me again, what does somebody have the right to do? Take stock from you at 110. Where can the stock go? What if the stock isn't spiders? What if the stock is Amazon and the stock goes all the way up here to 200? What do you do then? Oh, you vomit. Yes, you do. Yes, you do, because you sold the 110 call, which gives somebody the right to take stock from you at 110, but now the stock is trading at 200. What are you? You are in big trouble. Big. Why? Because you're going to lose $90. But you're like, but I collected $1. You know, that's the funny thing. That's the funny thing about selling premium. You're like, you sold something for $1. And when you sold that for $1, maybe you did have a 90%. I don't care about the 90%. Okay. What I care about is how much risk do you have in here? What I also care about is how could you actually clip that $90 of risk? I mean, really cut it down. There's always going to be risk in this marketplace, but how can you really clip that risk down? Now, the next lesson of selling premium. Okay. The next lesson is selling premium, and everybody gets into this. They turn around and they sell, for instance, this 110 call, and they collect $1. And then sooner or later, they do it on the other side, and they turn around and they go, I also sold a 90 put. Okay. And I also collected $1 for that. Now, here's the fun thing, because again, some people are brand new to options. They have no experience. The stock's trading at 100. Let me ask you something. Do we own the stock? Do we own stock? No. I never had anything to do with the stock. I don't even know the stock. I don't even care about the stock. I am not wearing any stock. Okay? No stock. I just sold the put and sold the call. What's a put? A put's the right to sell. You're like, what? Yeah. If you buy a put, you buy a 90 put, you have the right to sell the stock at, well, 90. That's if you buy one. We didn't buy it, though. We sold it. You go, how can you sell something you never owned? Well, it's a contract. You're selling yourself into an obligation. Now think about this. A put gives you the right to sell if you own it. But we don't own it. We sold it. So somebody else has the right to sell stock to me at 90. You're like, oh, my head just cracked open like a cantaloupe. Okay? If the stock comes down all the way to 80, somebody can exercise the right to give you stock at 90. Right? That's it. But because you sold that 90 put, you get to collect $1. You collect $1 here, collect $1 here. Then what do? Then you pray. Okay? Well, what do you pray for? You pray that we stay somewhere in that range. This is what we call, okay, market what? Neutral. The 0 indicates neutral. Market kind of neutral. Market neutral says, I don't care so much about direction. If we go up, whoa. If we go down, uh-oh. All I want us to do, okay, is stay what? Is stay relatively range bound. Now, this is just the beginning. We're going to go a little deeper now. Everybody okay? Maybe? Deep breaths? Deep breaths. Focus. Focus. Okay. Now, take it a step further. So here is a more, I guess, cut and dry slide. So we sell a 110 call for $1.50 credit. Right? We sell the 110 call for $1.50 credit. And we sell the 110 call for $1.50 credit. First of all, when you sell something for $1.50, what's the most you can make on it? When you sell something for $1.50, what's the most you can make on it? $1.50. That's it. Nobody's going to come back a week later and they're like, oh, that call you sold me, that was one good call. I'm going to give you more money. Listen, when you sell something for $1.50, that is it. That is it. That is all that you are going to get. By the way, yes, I've talked about calls enough that I have to make this amusing for me, not just for you. It's for me. So I sell the thing for $1.50, but selling it and selling it naked has risks. As we elaborated upon a moment ago, what if the stock were to cruise all the way up to 200? And people laugh about that, but that's no joking matter. I've seen this happen. And actually, I'll tell you exactly where I did see it happen. And I saw a very, very similar trade happen a couple of years ago. Some of you guys will remember this. It was before Netflix split, but Netflix jumped from 140 in earnings. Okay. It jumped from 100 to 143. And the very next day jumped to 167. That's before it split. Okay. And people sold a 110 call for a little bit more than $1.50. The 110 call was trading for about $4. It's trading for $4, but the stock was trading at 167. So don't think for a second that that kind of stuff can't happen to you, because it's a crazy business. So what do? Okay? Well, you hedge. What's a hedge? So now we're going to go out and now we're going to sell an option for $1.50 credit. Then we're simultaneously going to buy another option for a 50-cent debit. What are you making here net? Okay? Net, instead of making $1.50, now you're going to make $1. So now you're going to make $1. Your net credit is $1. What's the risk? Well, first of all, what's the difference between 110 and 115? Okay? The last time I looked, that's $5. So you have $5 of risk. You have $5 of risk, of which you collected what up front? Come on, tell it to me. Collected $1 up front. So what do you have? Okay? Max risk is $4. Okay? The width of the spread is $5. To figure out the probability in this trade, take the max risk, which is $4, divided by the width of the spread, which is $5, equals 80%. Okay? This trade has an 80% probability of making 1 penny or more. That's how figuring out probability. That's how easy it is. And you're like, wait, what? Okay? Told you. I want you to grasp big strokes of logic. I don't want you to get caught in the weeds. But to figure out probability is always definitive, is always embedded in the price of the spread. Take the max risk, divide it by the width of the spread, will equal 80%. This strategy has an 80% probability of making 1 penny or more. That's why I told you guys earlier, a monkey can figure out how to make 90% trades. Okay? It's not this business. I'm telling you, I didn't bring you here tonight to talk to you about, let's sell options. Selling options, anybody could do. Anybody can create an 80, 90% probability. Here's the whole key. You have to be able to do what? Huh? Anybody? What do you have to be able to do? You have to be able to keep the money. Because if you can't keep the money, what's the point of the strategy? Okay? What is the point of the strategy? 80% probability and what we term the 20% hammer. Okay? 80% probability and the 20% hammer. 80% sounds great. But 20% of the time, the market is going to completely rip your face off. Now, I want to go back to that because what's going to happen here, I'm telling you, okay, verbatim, what happened to you. This is what happened to you. You made $1 one time, and then you did it again. You made another $1, and then you made another $1, and you made another $1. By the way, this is 4 trades, okay? 4 trades went by, and you made money 1, 2, 3, 4 times. By the way, by the 4th time, you're no longer doing 1 contract, okay? By the 4th trade, how many contracts you do? And you're like, geez, come on, I'm the next Buffett. Come on, baby. I'm doing 10 contracts. And I'm not even doing 10 contracts in the spiders. Now I'm doing 10 contracts in the SPX because the market is just evil enough to know how to do that. Has anybody been through this progression? And what happens to you when you get to the 10 contracts? Okay? You're going to learn what the 20% hammer means. When you trade high probability strategies and you're wrong, you're going to get hammered. Right? In the market, it's just evil enough. It's just evil enough to allow you to make money 3 or 4 times. Okay? You increase contract size and then, train wreck. The losses are going to exceed the gains of the previous 3 trades and then some. I know. It's like I can see your account. Guess what? For 15 years, I did. I looked at accounts. I looked at hundreds of thousands of accounts. How can one person look at hundreds of thousands of accounts? How about when you have 7 million clients and you have an entire division of a company that does nothing, okay, but regression analysis on those accounts for you? I can tell you everything that has ever been known about iron condors and vertical spreads and calendar spreads, and I can even tell you who makes money selling premium and minimizing risk and who doesn't. Okay? This stuff is like, again, everything I'm talking about is experience of not just myself, not just other traders, not other market makers that I worked with. Everything I'm talking about is experience from watching 7 million retail clients, 7 million, okay, retail clients, of which there's the largest option order flow, okay, ever received in this business while I was actually in that position. and you start to learn things like this, okay? I can fix it. I know I can fix it. Fix, it's a really dirty word in trading. 15 years in the brokerage business has made me a bit of a cynic on that front regarding good trades gone bad. Anytime you're fixing a trade, you're adding more risk to an already losing trade and racking up transaction costs. That's kind of a fun topic as well. Am I hitting all the points? Okay, fixing a trade. So what do? What are the first things you learn in this business? One of the first things you learn in this business, you go, don't throw good capital after bad. And you go, Don, I'm not doing that. I'm fixing it. Well, you call it what you want. You want a definition for it? I call it, okay, throwing good capital after bad. You may call it a fix. You can call it whatever the hell you want, okay? Some fixes may work, but the very notion of fixing throws good capital after bad, and that's unequivocal. And anything you do to fix a trade, I want you to think about fixing a trade. Anything you do, there's one, okay, thing that is tried and true. Fixing a trade adds more risk. Oh yeah, and it adds more transaction costs. Okay? Yesterday's trash. I want you to think about taking a car and I want you to drive it off of a cliff and then I want you to bring it to a body shop. What are they going to tell you? The body shop's going to tell you the same thing about the car that I'm going to tell you about your losing trade. It's a piece of crap. Let it go. Okay? Do it right. You have to learn, okay, how to place the correct positions and how to correct good positions gone bad. Now we're going to get a little bit more in depth. Are we having fun yet? Okay? Because now we're going to talk about selling premium the right way. And this is going to take a few minutes, and I'm going to go through a couple of different, okay, slides in this way, and we're going to actually take you through this. Now, this could be any stock. It does not matter. But let's make it something like the spiders, because I think that the spiders are a good place to start. And let's say the spiders are trading at 300. I know they're not trading at 300, but I like big round numbers. So the SPY is trading right at 300. We're going to go out, okay, and we're going to sell. In this case, we're going to go out far in time. We're going to go out far in money. We're going to sell a 320, okay, and then we're going to turn around and we're going to buy a 325. Now, 320, 325. Don't worry about the expiration date. We worry about that later. Remember, earlier I talked about, you know what? Tonight you're going to learn concepts. Tonight you're going to learn more about like the right logic, okay? And then later on down the road, you got to learn what's called criteria. You know what criteria is? Criteria is knowing exactly what options to sell, knowing exactly what option to buy, know what this credit for the spread should be. Okay, those are the nuances that you're going to have to learn to make this work. So here's a spread. And on this spread, let's say for the first spread, okay, on that one, you're only going to collect, because this one's way out of the money, you only collect a whopping 50 cents. You're like, I don't like it. I don't like it. Now, if you collect 50 cents, how wide is this spread? It's a $5 wide spread. Okay, it's a $5 wide spread. On a $5 wide spread, if you collect 50 cents up front, what's your risk? Okay, your risk is what? $4.50, okay, of risk. So what would be, you tell me, what would be the probability embedded in that trade? How could you figure out probability? You take the $4.50, divide it by $5 equals, okay, this trade would have about a 90% probability. But what could happen to on it? You collect 50 cents, you collect 50 cents, you collect 50 cents, boom, all of a sudden you take huge losses. Huge, okay? And that's something that you're like, oh, I can defend myself. What are you going to do when the market rips higher? Okay, what are you going to do if the market sells off quick? Speaking of the market selling off quick, I'm not just going to go out there, okay, and sell that. I'm also going to sell, okay? I'm going to sell in this case, and again, these are calls up here. I'm going to turn around and I'm going to sell a 280 put. And then I'm going to go a little further out of the money, and I'm going to buy, okay, 275 put. And I'm going to put this one also, just to make this example easy, right at about 50 cents. Okay, so the exact same thing is true over here. All right, it's a $5 wide spread. Collect $4.50 up front. It's a party. What's the probability of that trade? 90%. But if I put the trades together, okay, If I put the trades together, none of this applies down below. You put the trades together, now you have what is called the mighty iron condor. Now, an iron condor, it ain't the end all be all. Okay? You could go online and Google what an iron condor is in about 2 seconds. No, nobody cares. Iron condors do not make you money. Okay? Criteria and risk management are going to make you money. If you don't learn how to minimize the risk in the iron condor, it doesn't matter what an iron condor even is. But what an iron condor is I'm selling out of the money junk up here, I'm selling out of the money junk down here, and I hope that we stay somewhere in the middle. Now, on this iron condor, I sold this for 50 cents, I sold this for 50 cents. So what's my net credit now? My net credit is $1. My net credit is $1. What's my risk? Well, I have $5 of risk up here and I have $5 of risk down here, but what's my total risk? Well, the last time I looked, this is a $300 stock, right? Where can this stock go? You tell me. Where can a $300 stock go? It's not a trick question, okay? Please enter the response now. Well, the stock can go up, the stock can go down. The stock can go up, the stock can go down, but the stock can't go up and down at the same time. So the total risk, okay, the total risk in the spread is what? It's only one side of this. So what do you really have at risk? The total risk in the spread, okay, is $5, of which you collected $1 up front. So definitive out-of-pocket risk, okay, is $4 of risk. What's the probability in the spread? $4 of risk divided by $5 of width. This iron condor has an 80% probability, of making 1 penny or more. It's pretty quick, right? All we're doing is like, wait, this is like just like before. Okay. Now, why is this selling premium the right way? Anybody? Why is this selling premium the right way? There's a lot of crap going on this screen. Okay? Anybody at all? Why would this be selling the premium the right way? Because right now, okay, up until this point, anybody could have figured that out of a book. Now we're going to get to the points that you can't figure out of a book. All right? Now we're going to get to the point where the biggest firms in the entire street use this logic. So you have these firms that they go out, okay, and they sell these iron condors. Okay? Now those little hash marks, what do they represent? So we had this $300 stock and we were selling what? The 320, okay? Then we're turning around buying the 325, so we're selling this, buying this, okay? Then we're turning around and selling the what? The 280s, turn around, buy, okay? The 275s. Okay. First of all, the biggest firms in the street, what they actually use is a mechanism called delta. Now, some of you actually know what delta is, okay? Delta. What it represents is how much risk. Forget about it. It's the rate of change of the option for every dollar move in the stock. Forget about all that. Okay? Delta is how much risk you're willing to ensue. It's how much risk the trade actually has. Okay? And what we can teach in a very short amount of time is how to actually use delta to manage this strategy. Now I'm going to show you, okay, one very important aspect. All risk mitigation tactics must be in place before the risk hits. I want you to always remember that, okay? We actually talk about selling premium and minimizing risk. All risk mitigation tactics must be in place, okay, before the risk hits. Shall I reiterate that again? Okay? How does that work? One of the first risk mitigation tactics, okay, that I can teach you is this. The market can rally up and the market can sell off. Which, okay, is the bigger risk on that? The market rallying up, okay, is up $20, okay, versus, for instance, down 20. For those of you that have traded a little bit, okay, what's the bigger risk to deal with, the up 20 or the down 20? Assuming we're in an index product, and we're not in a stock with earnings, we're not Tesla, okay, we're in an index product. Okay, what's going to happen faster? Stock moving up 20, the stock moving down 20. Now, we've had some fun and wild markets to the upside. There's no question about it. But even the most wild moves to the upside, even the most wild moves that we've seen to the upside have still been what? Okay, they've been relatively, easily obtainable. Like, when a market's moving up, you're like, I can see it coming. I can see it coming. What if the market though were to slip down fast? Well, we actually build a strategy. Okay, a very, very simple strategy. You know where we build the strategy? right here, right where the risk is. You know what that strategy is called? It's called a vol bomb. We can actually place what's called a volatility bomb. It's a very cheap trade. All it does is reduces all the risks to the downside. So when the market comes cratering, the volatility bomb ignites, okay? It ignites and it actually blows up and it saves you a huge amount of capital, okay? That's risk mitigation tactic number 1. It's one of the primary ways that people get killed because they don't think about, like, what am I going to do if it goes down? I'm going to tell you what you're going to do if the market goes down. You're going to get killed because if the market goes down, by the time you even react, it's too late. The option that you sold, you'll never be able to buy it back. And people have been through that. If you've been through that, you know exactly what I'm talking about. Risk mitigation tactic number 2. You never put on one big trade. Okay? Smart traders learn to layer positions into multiple time frames. Okay? This can be one expiration. If you've traded options, options have multiple expirations. This can be another expiration, another expiration. We smooth out the risk curve. Okay? All of this, all right, I just took 2 minutes to show you 2 very small nuances to turn around and sell premium the right way. If you had just done, okay, those very simple maneuvers, how much capital might that have saved you in the long run? Okay. On top of that, we can actually learn a little bit about delta and how much delta risk that we should or should not be taking. Meaning that there's a number and you say, like, I don't want to lose more than X. Let's say X equals $500. Did you know if you know your delta, you could tune your delta, okay, to exactly how much money you can make or how much money you can lose? Okay. You name it, selling premium the right way, it's all about, okay, the tactics. It's all about learning just a handful of strategies. It's not, okay, there is no one strategy that's perfect. People go, what's your favorite strategy? That doesn't exist, okay? It's the right trade logic. It's using things like, you know, an iron condor. Sure, it's a great strategy, but the iron condor alone isn't going to produce profitability, and many of you have found that out. You're going to have to learn things called volatility bombs. You're going to have to learn that when the market rallies big, you're going to have to continue to allocate to push these trades further out. Okay? This is not going to be incredible amounts of management, but I can't stress to you enough. In a rising interest rate environment, what do you think you're going to do? What, you think you're going to go out there and be the greatest stock picker ever? It's going to be a challenging environment. And the next, you know, the foreseeable future, right? 5, 10 years out, we're not just going to have stellar returns into the oblivion, okay? Markets right now are getting more volatile. It doesn't matter whether you think they're going to continue to go up or not. As they get more volatile, you're going to have to learn these tactics. You're going to have to learn to sell premium, okay, the effective way. And it's just, I stress this. By the way, all of the stuff, okay, all of the stuff that I'm talking about over here, it can be done in retirement accounts. Now, somebody asked me, like, can you explain the volatility bomb? There's actually a couple different types of vol bombs you can use. You can use what's called a risk twist spread, okay? Or you can actually use a type of a calendar spread laid in here, okay? The volatility bomb, oh, that's good. I mean, that's an hour conversation unto itself. And all of this, you know, accumulated, people get a little overwhelmed, as I said, all right? We have 45 minutes to an hour to explain some of this. Give me a couple of hours, you'd be amazed what we can get into. Fear not selling premium. Again, people have limited options experience, and the first time you've heard this, you're just like, my head's going to explode. I am telling you, this is the stuff that you want to learn. Do not let these options intimidate you. You need these strategies for the foreseeable market future. We'll show you how and when to place these trades in a matter of a few hours. And it does take a few hours, okay? What we do is we create very detailed recipes, okay? And including for selling premium, okay? You wouldn't bake a cake without a recipe, so why trade without one? The logic we discussed today, it is how some of the most successful firms on the street sell premium and minimize their collective risks. I know, that's where I came from. That's the world I came from. This is what you need to know. This is what you need to know to successfully sell premium and minimize risk. First of all, you need to know what makes a viable premium selling candidate. You got to know that right off the bat. And, I talked about spiders and I talked about SPX, but you're going to find out that there has to be a combination. It's not just one product. What volatility should I seek out? For those of you who don't even know about volatility, you got to know a little bit more about volatility. What should I seek out? What options expiration do I select? Right? So if you're going to sell premium, there's a lot of expirations, right? Do I do like right now, right? We're in October? October's almost over. Do I do November? Do I do December? Should I do January? There's weeklies. Can I trade weeklies? Should I trade weeklies? The SPX has 100 different expirations on it right now. What should be the delta of the options I sell? What options do I sell? Okay. What options do I sell against my position? I talked about something called a volatility bomb. You know what a volatility bomb is? Okay. It's selling other options against the current position. So you're going to have to learn, okay, a little bit more than just this is an iron condor. A lot of you guys know what an iron condor is. Right? Somebody's mentioned about like iron butterflies. Sure, iron butterfly, fair game. How do I roll my options and manage the risk of that roll? Okay. And what is the right amount of risk for me? You know what that means, the right amount of risk for you? Okay. That has everything to do with what we term delta. By the way, that means delta. We'll actually come in and fine tune. A big portion of what I discuss is about delta. Now, okay, if you've never heard about delta, about gamma, about theta, don't let any of that stuff again intimidate you. You're just going to learn what's the right risk for you. And delta, it's easy. Once you learn delta, you're like, oh, that totally makes sense. Why have I not been using this for years? Okay? Then you got to learn what steps do I take during market rallies? Like, what am I going to do if the market rallies? What do I do if it sells off? What if I do if we hit an extreme bout of volatility? What if I do if we get flat? That's what we do here at TheoTrade. It's what we do. It's criteria. It's all the what ifs. Trading is about the what ifs. It's what's a good stock or ETF candidate? What's the correct options expiration? How much capital do I commit? What strike price options? What strike price options do I buy? We have the answer to all your trade related questions. We just build recipes with definitive criteria. They're checklists for each strategy and all the variables that you're going to encounter. The how, the when, the why, at what price. Again, this really is just the beginning, all right, of some of the variables you're going to hit when selling premium, minimizing risk. And the secret really boils down to, it is in the sauce, okay? You can read about different strategies. You can read about premium selling, all right? There's tons of free stuff in the internet. Oh, this is premium selling. What it won't tell you is precision. It's not going to tell you. And by the way, even your brokerage firm, the brokerage firms, they can't do this in their education. They can't tell you specifics. That's why we left the brokerage firms. Okay, we left them because regulatory requirements are ridiculous. They can't say like, this is the right option to sell. Can you imagine you're teaching 7 million clients and somebody, okay, from a regulatory body says you can't tell somebody the right premium to sell. You can't do that. Okay, what do you say? You say, I'm out of here. Okay, and I'm telling you, we spent years fine tuning this stuff. We spent years, okay, digging into data analysis of what people did right and what they did wrong. Okay, you got to follow steps to build a trade. Here is how you can sell premium and minimize risk. This is the curriculum for an entire course that we structured behind selling premium and minimizing that risk. Okay, we're going to teach the logic behind selling premium so you understand why these trades work right now. How to build an options inventory so you spread your risk across multiple products. It's a professional's trader's guide to capital allocation. Capital allocation is critical. You'll know what to risk at all times. We demystify all of the Greeks. You'll know what delta is, okay? You know what your returns are. You know what your risk is. And the key that all long-term traders in risk management, if you understand how to manage your risk, you're going to learn to thrive in the markets. The Selling Premium and Minimize Risk, the course, actually this course, I have it in here. I'm the trade instructor. It says 4 hours. The course is actually closer to 5 hours because there's an added section in this course about the volatility bombs. The class slide deck, okay, is available immediately, okay? Everything is available immediately for, all right, you to stream, but you can download the entire class, the checklist, and the slide deck for it. This class also qualifies you for a reduced commission rate at a number of participating broker-dealers. We now have marketing agreements in place with E-Trade, TD Ameritrade, and Tastyworks. By all means, okay? We can tell you what those rates happen to be. I cannot tell you live. You can actually chat in if you're interested in the rates. This class is $297, okay? Again, the class, you sign up for it tonight. Stream the class starting tonight. Okay? There's no problem. Like, just start streaming the class. We are mobile friendly. You can stream it on an iPad, your phone, your Android device, whatever. We have another bit of a discount this evening, okay? Because we feel that everybody that comes to these presentations, you kind of feel like you've been there and you've done that. Many of you tuning in, you've been through the gauntlet of paid classes. It's probably how you learned what an iron condor was. You've been through paid classes, you've been through indicators, you've been through secret squirrel black boxes. By the way, I hate the term black box, okay, and more. And then you only find out, just buy this one last thing to make all the difference. But wait, there's more. At TheoTrade, we've just had enough of this educational, we call it garbage, educational garbage and sales pitches. So we intend to kind of put an end to it, and we intend to disrupt financial education. We're built by professional traders. Everybody here has a minimum of 15 years of experience. Educating you, okay, at TheoTrade, educating you is our only goal. We're not professional salespeople. Everybody here is a trader. Educating you is our only goal, and we demonstrate just that, okay? We introduce to you what we call Total Theo. It's unlimited streaming monthly membership. We have now changed everything that we do here at TheoTrade. We are now the Netflix, okay, of the financial education. What does that even mean? Total Theo Unlimited, we're $99 a month. How to sell premium and minimize risk, it's included in this, okay? So, you know, you sign up for $99 a month, and what do you get? You get everything. What do you mean everything? Well, you get how to sell premium and minimize risk. That's what we're talking about tonight. But you also get an additional 75 classes. Okay? Can you watch them all in, like, you know, a day? Probably not, because each is 3 to 4 hours in length. But all of that is available immediately, on demand. There's new monthly classes. There's a live trading room. By the way, yeah, you know what? It's not good enough just to go through a class. I don't believe in that. Okay? I really don't. It's not good enough for you just to go through a class. So we broadcast live 6 hours a day. Can you make it all 6 hours a day? Of course not. So what do? Okay? Everything's archived. It's all archived. Okay? There's indicators. There's 59 proprietary indicators and scans. So if you're looking for, like, you know, your MACD, your Fibonacci, but no, we actually have people that write code for us. We have 59 proprietary indicators and scans. We don't charge any more. It's $99. You know, if you sign up for 1 month, you can still go through this class. You can get all the indicators. You can see the broadcasting live. We email trade ideas. We have daily coaching sessions, stocks, options, futures. Oh yeah, and we answer all your questions on email, okay? Or live in the chat room, theotrade.com/premium. Now, I'm going to show you a couple other things in this, okay? By the way, what our members are saying, this is one that I'd like to read through. It's really refreshing, okay? It's really refreshing to have you guys putting this together and sharing knowledge and not upselling everything and turning and burning your customer base. You got a customer for life in me because of the approach, okay? And I'm sure I'm not the only one. And I feel pretty strongly about that one because we're not. Listen, we are here to educate you, and we think, you know what? If you don't think $99 a month is fair, we got to talk. Because this selling premium, minimize risk, people used to pay thousands of dollars for that class. All the way back in like 2001 when I first started, we used to charge $2,000, okay, per day for a class that I would teach that was similar to sell premium, minimize risk. $99 a month right now. The internet has changed a little bit, right? And you got to look at this as, can you go out and just sign up for the selling premium and minimize risk? Yes, but we will charge you $297. Or, okay, we'll charge you $99 per month for unlimited streaming. Why do we do this? Okay, because we're so sure that you're going to love unlimited streaming. We would rather give you the $200. take it, okay? And I'm dead serious about that. You know, there are 75 classes, totally overwhelming. I don't know, for $99 a month, though, would you rather be overwhelmed or underwhelmed? Because most of you guys, if you've gone out and paid $500 or $1,000 per class, it's ridiculous. Paid $99 a month, you're never going to go anywhere else ever again. And we're so sure that $99 a month, you can cancel anytime. There's no minimum here. $99 for the first month. You don't like it? Leave. We get it. Hopefully we part friends. But at $99 a month, okay, you can stream till your heart's content. Monthly classes, live trading room, everything's archived 24/7, email trade ideas, trading indicators. I'm going to show you. It's TheoTrade.com/premium. Let me actually take you over to the site, then I'm going to actually answer a couple of questions. And again, I'm going to throw this up here because I want you guys to see what we do. Okay, this is the address, TheoTrade.com/ okay, PREMIUM /premium. And I stress to you again, you will love what we are doing. And again, it's $99 a month. Now, do we give you the option to sign up for $297? Yes. Some people are just adamant. I'm going to sign up for $297. Fine. Okay. But at $99 a month, spectacular deal. Now, let me take a couple of questions. I invite you to sign up for it. A few of the questions that always come up over here. First of all, is this a membership for $99 a month? Can I cancel anytime? Absolutely, you can cancel anytime. It was the first question that ever came up. Okay, right? Number two, somebody said I can't get approved for options because I'm a newbie. We will help you get approved for options. We will guide you through that process, right? We will guide you through that process. Can I do this in an IRA? Absolutely. Okay, we can help you around the day trade margin rule. If these classes, okay, if I can't make them live, everything is recorded. Okay? If you can't get your head wrapped around options, we'll help you get your head wrapped around options. Why? Hey, listen, we have an entire, if you're brand new to this, here's a start here menu. How about, again, everything that you need to learn in this business. Apologize, I just clicked on something. Everything you need to learn in this business, starting at options 101, 201, 301. It's all here. It's all archived. You want to see what our site looks like? This is what it looks like. All right, this is the live trading room. Down below, look, this is actually a trade that I did today. Okay, trade was mildly profitable. I bought something at 210, I sold it for 255, but we're posting trades in there throughout the course of the day. We also email trades out. Okay, we have got a start here section. If you're brand new to TheoTrade, you're like, I'm not ready for sell premium. Good, I get it. Start here. Okay, we have a member home. What's member home? It'll actually teach you how to use the site, and everything is searchable. You name a topic of discussion, it's in there. Next, the class archive. Okay, we have option classes, we have newbie classes, we have day trading classes, trend trading classes, hedges, futures, okay, mindset, pairs trading. You name a topic or a genre of trading, we've got it. We have 7 full-time instructors. Nobody in this industry, okay, has 7 full-time instructors that are working, all right, 40 plus hours a week to produce this kind of quality in terms of classes, and they all have a minimum of 15 years. And that's why we put this together, okay? Right now, somebody just asked in here, can you watch some of it offline? Yes, because we just built a mobile application. Okay, by the way, we have a small account class. Somebody said, how about a small account class? Of course we have a small account class. In fact, it's under option strategies. You know what it's called? It's called the small account class. And I can't even make that up. It's small account options trading workshop. Sold. Okay. The other thing, I want to tell you guys something about this. We have, and somebody just asked, how many members do you have? We're just shy of 3,000 members. I don't care if there's 5,000 members. I will continue to hire, okay, the quality of instructors that people have come to know here at TheoTrade. One other thing I'm going to offer you, you sign up right now tonight, okay? If you want to learn sell premium, there's a lot of classes that I kind of say that you should kind of go through, not just the sell premium. I will email you personally all the different classes. Email us support@TheoTrade. Sign up tonight. Email us at support@theotrade.com. I will get back to you, okay, by tomorrow mid-morning, and I will tell you precisely the classes to watch to get you ramped up to be able to sell premium and minimize risk most effectively. I will literally walk you through all of it. And I want you guys to know, again, I answer the emails. This is not like, somebody with the name Don in there. Okay. I will answer every single email individually. Doesn't matter. I don't care if I spend 5-6 hours. People have to learn how to do this stuff. I left a very prestigious position at a big brokerage firm to build TheoTrade because we're here to help people to learn this stuff. And the only way to do it is a little bit of Q&A, maybe a little pain, a couple of emails, but it's important to us. With that, I want to thank everybody for joining us tonight. Please, by all means, email us. Sign up, theotrade.com/premium. Have a wonderful evening, everybody. Bye-bye.